Bitcoin keeps dropping so hard, and I know a lot of you are thinking, where is the bottom? So in this video, we'll talk about Bitcoin, we'll talk about silver, gold, and all the markets that are crashing right now, and what is driving all of this, and where are we finding the bottom. So Bitcoin currently trending at 78k level. It lost the 80s, now we've dropped to the 70s, and we are at the April 2025 when Trump started announcing the tariffs. We are at the same level right now, and I think we will still go down. If I show you this chart, I think we're going to find the bottom somewhere around the 75 and potentially the 65k levels. This is for me where I see us finding the bottom. We still have some momentum. On the positive side, I think we are very close to reaching that over the next couple of weeks, I would say. As you can see here, if we go back to, let's say, the bear market in 2022, we had a drawdown of more than 70%. The positive side is I don't think we're going to go that deep this time. We are now in a different type of cycle with institutions, with governments. In 2022 was pure retail mania, if I can call it this way. So I personally think we're gonna go down a little bit more, the 70s, potentially below the 70s. We are close to reaching that now, but that would be around 50% drawdown from the all-time high we had months back at 126-25k level. So we are close to the bottom in my opinion, and we should see that over the next couple of months. And this is where I think we would see now we have the new Fed chair who Trump is encouraging and is hoping to start cutting interest rates. We're going to see a lot of money printing. That would start potentially in 2026, and this is where we would see massive liquidity coming into the space. What is happening right now, if I can simplify the picture? We see BlackRock dumping, we see exchanges dumping, and this is creating forced liquidations. We have a lot of stop losses being hit, and this just creates a cascade of downwards momentum. Exchanges are selling at the top, they are creating panic, retail investors are selling at lower levels, and eventually what is happening with those forced liquidations and pushing the price down, whales and big people, big players are selling high and they are buying low. 70k, that's even now we are currently sitting at the average buy price that Sailor has bought Bitcoin at. And I think, as I said, we are coming very close to a bottom where we would see now, at the same time institutions are selling, but at the same time so smart money is accumulating at cheap prices. So it's manipulation from both sides, from up, down, and then from down, up, we have smart money also accumulating. That's if you're holding solid projects on spot, if Solana, Ethereum, C, those kind of projects, I can guarantee you that these would recover in 2026. If you're holding some small market cap projects, maybe it would be a better idea to sell what you've got left and rebuy for the same amount, because now you have a chance of making 10 to 20x on the small market cap projects once we see this massive liquidity flowing into the crypto space. But if you're expecting your project to fully recover, if it's like 50x down or something like that, it would be very difficult. You rather sell, and then if you're holding solid layer ones, just stay calm, patient. If you can buy a little bit more, that's perfect. If you can't, maybe just try to distract yourself a little bit. As I said, we would find the bottom very, very soon over the next couple of weeks or so. And this is where hopefully we would see money printing starting, we would see rate cuts and massive liquidity flowing into the crypto space. We would see this fully financial reset of the system, and the dollar crashing, US refinancing its debt by printing money, by cutting interest rates, and hopefully the markets like Bitcoin, crypto markets, and commodities benefit from this move. Now, we will not talk about the altcoins because we know they are massively down. As I said, if you can buy, do so. Great discounts, great buying opportunities. Don't go all in. That's one thing you should remember. If you have money, invest some and keep some more on the side, because as I said, we still have, in my opinion, some more movement to the downside, and potentially this will push the altcoins down a little bit more. So be prepared in either case. That's on this. Now I want to move on to something as well interesting, and it's all linked together in a way. Commodities. I know some of you here are also into commodities. I personally bought silver as well. What we saw on Friday, we saw silver and gold collapsing. Silver collapsed 31%, the biggest daily loss recorded in the history. Gold dropped 11%, platinum fell 20%, palladium dropped 16%. Total damage, that's $7 trillion wiped from precious metals in only 24 hours. And that wasn't a market event, that was a crime scene. It was planned, it was timed, it was executed operation. And the proof is sitting plain sight inside the COMEX report dated 30th of January 2026. Once you see the data, I'm sure you will see the planned action too. So in single day, we set the biggest loss in history. These numbers are so ridiculous because they expose the whole system. On January 30th, COMEX silver traded roughly 363,561 futures contracts, plus more than 28k options contracts. Each silver contract represents 5,000 ounces. That means in one day, the paper silver volume represented 1.98 billion ounces of silver traded. Now, if we compare that to the reality, global silver mine supply per year is only 850 million ounces annually. So COMEX traded more than double the world's yearly silver production in one single session. That's not price discovery, that's liquidity control using fictional ounces. And here is the moment that exposes everything. The COMEX report shows that JP Morgan Securities stopped 633 silver contracts. Stopped means they took delivery. They covered shorts and accepted metal. And when did they do it? Near the bottom. Not close enough, exactly at the bottom of this crash. Silver fell from 100 to the low 70s. At the mathematical low of the entire move, JP Morgan closes shorts. What happens after that? The price starts recovering immediately. This is not coincidence, this is not luck. And this is how institutions manufacture those crashes. And what I'm going to tell you next applies actually to crypto as well and Bitcoin, because we see now exchanges are selling. BlackRock is selling. By the way, the US government holds all their crypto. The governments are holding their crypto. Michael Saylor is holding crypto. We only see exchanges doing that and some institutions. But this is how they actually manufacture the crashes. They dump massive supply into the market. They overwhelm the order book. Price drops fast. Stop loss clusters trigger because they know where those are. Forced liquidations cascade. More stop losses are hit. Panic intensifies. Weak hands get wiped out. Then at maximum fear, which we've been now for a couple of months already when it comes to crypto, they buy. They cover shorts. When it comes to silver and commodities, they take delivery and they profit from both sides. This is the classic market manipulation mechanics. This time it's turning into something historical, especially when it comes to commodities. And here is the part that the mainstream media won't touch. While, if we go back to silver, paper silver was being crashed, the physical market was doing the opposite. Dealers reported delivery delays jumping 8 to 16 weeks, inventory was disappearing, and the biggest proof, the Shanghai premiums stayed $37 above COMEX. That means China was paying around 44% above paper price even after the crash. That's insane. In a real crash, premiums collapse. Instead, premiums this time held strong. That tells you the truth. The physical market is screaming shortage. The paper market is screaming manipulation. That's the reality. And what does that mean to you? If you're a long-term holder, physical holder, this changes nothing for you because physical demand never broke. But if you're a short-term trader using leverage, that is a disaster. 31% daily drop with leverage means liquidation. And I want to tell you that over-leveraging precious metals is suicide. So it's better to have physical silver and hold it for longer term. Because in short term, we see commodities being very volatile. But on a bigger scale, years, if you zoom out, we see a consistent uptrend. Now, talking about zooming out, All of that we're seeing right now doesn't happen in isolation. That same week, the US government shutdown fears peaked, and the first US bank failure of 2026 happened. Metropolitan Capital Bank and Trust in Chicago, some small bank, liquidity tightened, counterparty risk rose, trust started cracking. And right at the same time, paper silver got smashed. So this was phase one, liquidation. But phase two is coming, and this is where it gets interesting. If you've been monitoring data from the Chicago Mercantile Exchange, one of the most important financial exchanges on earth, what you would see there should not be possible in a functioning solvent system, because the Chicago Mercantile Exchange has gone dark. Not a power outage, not an information breakout. We've been trying to pull, if you've been trying to pull daily delivery notices, issues, and stops data, these reports, which actually show the demanded physical delivery, you would be getting nothing. You would be getting silence, fields populated with zeros, time stamps frozen, and reports haven't been updated since last week. And of course, this is labeled as technical issues. And happened to land on the same weekend as one of the most violent weeks in modern gold history, the crash that we see. Is this coincidence? I don't think we believe in coincidence here. And let me explain to you why this is not a coincidence. The Chicago Mercantile Exchange publishes two critical sets of numbers: volume, how many contracts were tracked, and number two, issues and stops, how many of those contracts actually resulted in physical delivery. Meaning, someone didn't just trade paper, they demanded the actual silver bar. Those numbers have to balance. If 100 people stand for delivery, the report must show 100 notices issued. But for 2 weeks, we've been seeing irregularities, volume suggesting massive deliveries, but the delivery reports showing nothing, or mathematically impossible numbers. And now, the report simply doesn't update. Last week, they released a vague statement, technical reporting issues. That's corporate language for we have lost control of the numbers, we have lost control of the ledger. What happens in situations where the demand is huge? The computer says 5 million ounces, but the shelf is empty, and that's when panic starts, because if they publish their real numbers showing a sudden collapse in registered inventory, you don't just get volatility, you get a global run on the votes. So what do? You should off the scoreboard, you stop reporting, you buy time, and you call it technical issues. And what is the number that proves that something is broken here? The $283, that's the number which is showing us the broken system. New York paper gold is roughly $5,200. Mumbai physical gold is roughly $5,483. That's a $283 spread. That should not exist in a functioning market, because arbitrage bots exist. High frequency firms spend billions to exploit 1 cent gap. If gold is 0.1 cents cheaper in New York than Mumbai, they buy New York, they sell Mumbai, and close the spread instantly. So why hasn't the $283 gap been closed yet? There is only one answer to this. You can't move the metal. The arbitrage trade requires two steps. Buy cheap paper in New York, take delivery, ship, and sell in Mumbai. Step 1 works. But step 2, this is where the brick wall is. This is where the issue is, because risk managers know if they buy the New York contract, they may never receive the gold. Basically, arbitrage is dead. And when arbitrage dies, the global market dies with it. We no longer have one gold price. We have a fake paper price and a real physical price. And it isn't just gold. Silver is screaming even louder than gold. Reports show spread between a London spot and physical in Hong Kong blowing out to around $13. That's more than 10% of the entire price. Normally, that spread is pennies, and this tells us that the metal is trapped. Flow has stopped, liquidity has hit zero, and this is systematic seizure, the financial equivalent of a heart attack. The blood isn't pumping, and when the blood stops pumping, the tissue dies. And here is the second part of the trap. Hong Kong vault systems suddenly go into maintenance. HSBC Hong Kong and other custodial vaults together started freezing withdrawals. You try to move metal, pending. You try to allocate bars for export, pending. And official excuse is cybersecurity upgrades, compliance updates, but this is not maintenance. This is stage this is planned because Hong Kong implemented new legislation effective 1st of January 2026, which says that a critical infrastructure ordinance, meaning in a cyber threat environment, authorities can freeze systems considered critical infrastructure. And what counts as critical infrastructure there? It's financial clearing systems, settlement layers, vault operations, precious metals custody. So if you connect the dots, Chicago Mercantile Exchange goes dark. Cyber narrative escalates. Hong Kong invokes protection. Vault gates lock. So there is no shortage, just security. Metal checks in, but it doesn't checks out. And the interesting part is what's gonna happen on Monday once the markets open. We have two cases, two scenarios. Once the markets reopen, if you are shorting the markets right now, you're kind of trapped. To close your short, you must deliver physical or buy it back. Since metals can't move, only price can move. This sets two possibilities. Option A is violent repricing. We see a huge vertical candle, and this candle will be to the upsides. You will see a gap up that looks like a glitch because all the shorts will hit buy and nobody will sell. Option B is the nuclear option, force majeure, cash settlement only is offered, meaning basically we can't deliver the metal, here is your cash, take it and go. But at what price? Would it be the New York fake price? Would it be the Mumbai real price? This will be a legal battle that could become very bloody fight in the modern market history. So we would see that either we have a huge spike to the upside, the repricing event, and this is kind of more aligned with what JP Morgan is doing. They sold everything, they forced the liquidations, as if they know that this is the bottom and now we're going to start moving up. We'll see this repricing event. Or on the other side, as I said, we might see force majeure event that people can't really do anything, just receive cash, the cash settlement option only. So I would say the safest bet when it comes to commodities is holding physical commodities, physical gold, physical silver. Because as you can see, we see freeze withdrawals, post settlement. The physical metal is worth more than paper promises. We'll see what happens on Monday. We're probably going to have another session, some analysis that I'll post on Discord. If you want to join, feel free to access it from the comments in the description below. Thank you for watching. I'll see you in the next video.